In this session, we're going to talk about a thing called cash flow. In previous sessions, we've taken you through the profit and loss and the balance sheet. Now, as we've talked about, profit and loss records the result of the business over a period of time, and the balance sheet records the business's situation at a particular point in time. Cash flow is completely different to profit. I've seen numerous businesses over the time which have been highly profitable, but have gone broke because they haven't had cash flow. The old adage is that cash is king. Now, what we need to remember in most businesses where you supply customers, you will supply those customers with the view that they will pay you not at the date that you supply them, but at some point later on. And we talked about, when we were looking at the balance sheet, the current assets in the balance sheet, the account called debtors or accounts receivable. So what can happen, and the easiest way to explain it, is that we do it on a timeline. So we've got a sale on a particular date, and we recognise the revenue or the income at the date, at the time we make that sale. Now, what can happen is that we'll actually collect that sale, collect the dollars from that sale at some point in between those two dates. Now, we make the sale, that's all great. Depending on how long this period is, it can cause you massive problems in your business, because we've seen some businesses that work on 7 days, whereby they make a sale and they'll collect the revenue from that sale in 7 days' time. A lot of businesses work on 30 days terms, whereby they'll make a sale and a month later they will collect the revenue from that sale. A number of businesses work on 30 from end of month, which is, let's say in this situation, we make a sale on the 1st of September. We get to the 30th of September and we then wait another 30 days to collect that revenue. So that can be less than or equal to 60 days term. So once we've made a sale, it can take us up to 60 days to collect that. A number of businesses, particularly when they start getting into a little bit of strife, will start stretching their customers. So we make the sale, one of our customers is in a little bit of financial bother, they can stretch us out to 45 to 60 days. So it takes us 2 months, or 2.5, or 1.5 to 2 months to get paid. And then you'll often see, for those of you that have looked at a debtor's ledger or an accounts receivable ledger, you'll also see 90 and 90 plus or 120 plus, which means that those customers that are listed in that section are taking at least 3 months to pay us. Now, in that situation, we've got a sale, we've incurred the costs for providing the service or the good or the product to our customer. If they're taking this long to pay us, do we really need them as a customer? Because that is sucking up a hell of a lot of cash whilst we do that. I'll give you an example. One of our customers runs a trading business. They supply product to a range of businesses around our region. We did some modelling for them on their cash flow, and we worked out their debtors account, their accounts receivable account, runs at around, I think it was around $600,000. Okay? And when we look at this, we look at a thing called average debtor days. Debtor days. So that's the average amount of time it takes us to collect a sale once we've made it. And theirs were running, I think, at around 60 days. Okay? And the cash flow in the business is fairly tight. Now you can do a very, very simple calculation here as to the value of collecting your debtors a bit more quickly. So if we've got $600,000 worth of debtors, we've got 365 days in the year. Okay? $600,000 divided by 365 days results in an amount of around $1,650 per day. So they were running on 60 days. If we could get their debtors days by better collection techniques down to 50 days, reduce their debtors days so they collect the money faster and all that sort of stuff, it makes no difference on their sales. Absolutely none, because they've still made the sale. What it does to their cash flow, however, by bringing that in, we get the benefit of that $1,650 every day for another 10 days. So that effectively improves our cash flow by $16,500. No effect on profit. Big effect on our bank account. Now, what this customer did when we highlighted this to them, they actually made a concerted effort, and their cash flow situation improved markedly, such that they didn't have the cash flow issues that they were having when they were in the 60-day, average days, 60 days. They're now down around, and they're staying around the 50 days. The issue is, if the debtor's control gets out of control, then that's going to take all that money back out of the bank, and they're going to fall back into the cash flow constrained area. So you need to, when you're running accounts and looking at cash flow from your cash collections, you really need to make sure that you're getting your debtors' money in as quickly as possible. Now, there's two ways of doing that. One is invoicing quickly. So the quicker you invoice, the quicker you get paid generally. Second issue is get onto them. If you've got debtors that owe your business money, and your terms are, say, 30 days, and you don't do anything about collecting it until they're at 60 days, you're going to set yourself up for a lot of cash flow pain. If you're providing 30-day terms, you start hassling your customer at day 31 and say, look, you owe us this money, when can we expect it? There's a number of tricks and traps for people with collecting money that you need to be aware of. But as you can see here, by getting the money in a little bit quicker, as I said, doesn't make any difference to your profit, but it makes a hell of a difference to your cash flow every day, every week, every month, every year. And you've really got to be aware of it. I'll explain more about cash flow in another session.